So guys, we are going to start with chapter 2. I am recording the class right now. I am putting up my screen. Are you guys able to see my PowerPoint? If you are not able to see my PowerPoint, please let me know so I can adjust it accordingly, okay? Um, this week, we are going to begin talking about job order costing. So this method of job order costing systems are used for a variety of reasons, but usually when many different products are being produced in a given period. Also, we're going to look at a video where we're going to see how job order costing happens when products are manufactured to a specific order, where the unique nature of each order requires tracing and allocating costs to each job and keeping track of costs for each particular job. Here are some examples of when people utilize this job order costing. It is sorry here. Slide resume section. Okay. It generally occurs with very big items, big ticket items, producing an aircraft, building a home, creating roads, large scale construction, and movie productions. Now, one thing I'm going to spend a little bit of time looking at some of these examples that I have available that show, one second here, one second. So let's start with this. And if you, I'm going to put it up loud. I hope you can hear it.
Here, we will consider a common type of absorption costing system known as job order costing. A job refers to a customized product or service output provided by a company. For example, Vanilla Bicycles in Portland, Oregon produces only 40 to 50 bikes each year that sell for an average of $7,000 a piece. Each bike is manufactured to the customer's exact specifications. For example, the frame is customized to the buyer's measurements, and the buyer can choose a preference of seat style and paint finish. For cost accounting purposes, each customer order for one or more of these bikes is called a job, because each of Vanilla Bicycle's jobs has unique manufacturing specifications. The cost incurred to produce each of its jobs differs. So, companies use job order costing systems to accumulate the costs incurred to produce these individual jobs. Manufacturing companies use job order costing systems to assign direct materials, direct labor, and manufacturing overhead costs to jobs. As their names imply, direct materials and direct labor costs can be direct
Okay. I hope that was helpful. But I oftentimes like to do these because it just gives an example of what we're going to talk about today. So as we get back to our PowerPoint here, what we're going to do in the job order costing system, as you saw, we are going with various jobs in that example, bike A for Aaron, the second bike goes to Melissa, the third bike goes to Jim. They're going to keep track of the materials that go to each specific job and the direct labor that is actually being worked on for each specific job. And the direct materials and the direct labor can be easily assigned. However, those indirect costs that we call manufacturing costs get allocated to jobs rather than directly traced to each job. It's really hard to trace them to each job because they are indirect. They aren't directly associated with those jobs. So what happens, each job has a job cost sheet. And this job cost sheet is really important to track what actually is going into these various individual jobs. So we know in this example for materials, for this job A-143, we know we have exactly 12 feet of 2x4s, and we have, or 12 of those of 12 feet 2x4s. We have 20 of 12 feet of 1x6s. So what happens is the direct material gets allocated to the job cost sheet. The same thing happens with labor costs. The labor, when an employee is working on a specific job, the employee's time ticket will earmark what job they were working on. So you see here, 8 hours were associated with job A-143 here. So that also gets added to the job cost sheet. Pretty straight. We can directly assign the materials, direct materials, and the direct labor. But when we're dealing with manufacturing overhead, it's very difficult to allocate how much manufacturing overhead goes to a job. So what we do in managerial accounting is we're going to allocate or create a base. This base, usually direct labor hours or machine hours, we take that allocation base and we use it to assign the manufacturing overhead to individual jobs. Why do we do this? It's hard to trace all the costs related to various particular jobs. And this manufacturing overhead consists of everything. How can we possibly assign it? And while many types of manufacturing overhead costs are fixed, they still can fluctuate throughout the period. Think about this. In winter, you have more electricity and heat, well, more heating than you would in summer. Therefore, is it right to assign, just because you're producing something in the dead of winter, more manufacturing overhead than if it would be produced in the summer, and vice versa? So the way we figure out and determine the manufacturing overhead, we are going to create what we call a predetermined overhead rate, POHR, predetermined overhead rate, that we're going to use to apply overhead to jobs before the period begins. I just want to bring up a thought. Manufacturing overhead, we really don't find out what the costs are until after it's done, which is why we need to go based on past history and assign a rate. This allocation base, such as like direct labor hours or direct machine hours, is what we call the cost driver. What drives the products? What really can help to determine the time spent on a project or a job. So the way we calculate this POHR is we take our estimated total manufacturing overhead costs, divide that by our estimated total units in the allocation base for the coming period. So we take this and we deal with a POHR, predetermined overhead, because the actual overhead isn't known till the end of the period. Thus, it inhibits us being able to figure out costs. And we also know that actual overhead costs can fluctuate seasonally. So how we're going to determine this predetermined overhead, we are going to compute it before the period begins. We're going to estimate the total amount of the allocation base that's going to be required for the next period's estimated. You see, these are all estimates. You see, estimated allocation base for the next period's estimated level of production. Then we're going to estimate the total fixed manufacturing overhead cost and the variable manufacturing overhead cost per unit of the allocation base by using the formula where Y is the estimated total manufacturing overhead cost equals A, which is the estimated total fixed manufacturing overhead cost, plus BX. B is the variable manufacturing overhead cost per unit of the allocation base, and X is the estimated total amount of the allocation base. From there, we will get to compute the predetermined overhead rate. So we're going to take exercise 2.1 for this scenario. I just wish I could remove this piece here. If anyone knows how I do it, let me know. So Harris Fabrics computes its plant-wide predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 20,000 direct labor hours would be required for the period's estimated level of production. The company also estimated 94,000 of fixed manufacturing overhead costs for the coming period, but the variable manufacturing overhead is $2 per direct labor hour. So Harris's actual manufacturing overhead for the year was $123,900, and its actual total direct labor was 21,000 hours. Compute the company's plant-wide predetermined overhead rate for the year. So guys, you see here, they're giving you more information than you need. What is it we need to compute? the predetermined overhead rate? Well, we're going to take the estimated total manufacturing overhead, which is the 94,000. And then we're going to take the estimated variable manufacturing overhead, which was $2 per direct labor hour. And the estimated direct labor hours was 20,000. So our total estimated manufacturing overhead is 134,000. That 134,000 divided by our cost driver of estimated total direct labor hours, 20,000, means our predetermined overhead rate is $6.70 per direct labor hour. Guys, the one thing, if I can emphasize enough, is that they're going to provide you with more information, and they want to make sure you know what you need to decipher the correct, what is the correct information you need in order to determine that predetermined overhead rate. Now, how do we go about taking this and applying it to jobs? So what we'll do is Pear Company estimates it's going to require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates total fixed manufacturing at 200 and variable at 275 per hour. So we come up with the estimated predetermined overhead of $4 per hour here. How do we go about applying it? If our direct labor hours associated are 8, then we're going to take our POHR of $4 per hour based on the direct labor hour, which is going to be the same as a direct labor, or the manufacturing overhead rate is going to be the same as direct labor hours, to come up with the direct labor hours of 8 times that predetermined rate of 4 gives us our manufacturing overhead of $32. So you see, it's really important to keep track of costs, because we don't know if we're making money or losing money on jobs if we don't know the cost associated. How's everyone doing so far? Any questions before I go on to this next exercise? So Luth and Company uses a plant-wide predetermined overhead rate of $23.40 per direct labor hour. This predetermined rate was based on a cost formula that estimated $257,400 of total manufacturing overhead costs for an estimated activity level of 11,000 direct labor hours. And the company incurred actual total manufacturing overhead costs of $249,000 and 10,800 total direct labor hours during the period. So what we'll do is determine the amount of manufacturing overhead costs that would have been applied to all jobs during the period. So if our actual direct labor is 10,800, our predetermined overhead rate is $23.40. The manufacturing overhead applied would be A times B, which is 252,720. This is what actually was applied to the various jobs. Okay, now look at something here, guys. Do you see in this example Our estimated activity level was 11,000 hours. But do you see we really only had 10,800? That makes sense? So when we created the predetermined overhead rate, we did it based on 11,000, yet we only came in at 10,800 hours. So our next thing here, we're moving right along, is to compute the total cost and the unit product cost of a job using this plant-wide predetermined overhead rate. You see here, this job cost sheet shows us we have our direct labor materials, we have our direct labor, and we have the manufacturing overhead. So we've got our total cost on this job number A-143 to be a cost of $268. But that's the total cost. How much is the unit product cost? Well, in this case, since we can see here we completed 2 units, we take our total cost and divide it by 2 units completed to make it $134 per unit cost. Let's look at this one, guys. Job WR53 at NW Fab Inc. required $200 of direct materials and 10 direct labor hours at $15 per hour. Estimated total overhead for the year was $760,000. And estimated direct labor hours were 20,000 hours. What would be recorded as the cost of job WR53? Take a minute and look at this and come up with your answer. And then I'm going to put up a polling question so you guys can answer. Was it A, B, C, or D? Okay. 200 direct material, 10 direct labor hours, and then the manufacturing overhead. You'll come up with a predetermined rate. How much is that going to be applied to the job? Is it going to be I should have a new poll here, I thought. Am I screwing this up? Stop sharing this out. Oh, let's just do number 2. For this problem, what is the correct answer? How many said A? How many said B? How many said C? And how many said D? So we've got some, yeah, why don't you guys tell me what you think? For this problem, is it A, B, C, or D? Come on, I've only gotten 9 responses. There's 22 of us here. Anyone else? So, how many? We'll see what the norm is here. D. D shows the predetermined overhead rate should be 38 bucks. And since there were 10 direct labor hours associated, the amount that would be allocated to this job would be $380 for a total cost on this job to be $730. So, inaccurately assigning manufacturing costs to jobs adversely influences planning decisions made by managers. Job order costing systems are able to accurately trace the direct materials and the direct labor, but job order costings fail to accurately allocate manufacturing overhead during the production process. Therefore, we've got to come up with an allocation base that we call drives the overhead cost so we can more accurately figure out what the costs really are on this job. That cost driver is really important to decide what is going to be the cost driver. Many companies determine a single predetermined overhead rate to allocate to manufacturing overhead costs. And they usually do it based on direct labor hours. But it doesn't always work that way. Direct labor hours might not always be the best way to go. It can be simplistic, thinking that direct labor hours are the best way to allocate costs. However, if more than one overhead cost driver can be identified, then it's helpful because we're going to be more accurate in determining what the true costs are. In that case, when we can come up with more than one cost driver, we will use what we call multiple predetermined overhead rates. Now let's look at this. This exercise 2.6. Tech Solutions is a consulting firm that uses a job order costing system. Its direct materials consist of hardware and software that it purchases and installs on behalf of its clients. The firm's direct labor includes salaries of consultants that work at the client's job site, and its overhead consists of costs such as depreciation, utilities, insurance related to office headquarters, as well as office supplies that are consumed serving clients. Tech Solutions computes its predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it is estimated that 80,000 direct labor hours would be required for the period's estimated level of client service. The company also estimated 680,000 of fixed overhead cost of the coming period and variable overhead of 50 cents per direct labor hour. The firm's actual overhead cost for the year was 692,000, and its actual total direct labor hours was 83,000 hours. I want you to take a moment and compute the predetermined overhead rate. Then number 2, during the year, if Tech Solutions stated and completed the Xavier company engagement with direct materials being 38,000, direct labor hours being 21,000, and direct labor hours worked of 280, what would be the total job cost for the Xavier company agreement? I'm going to just pause my recording for a minute, and I'm going to give you about 5 minutes to come up with. So guys, in this scenario, we first have to determine the predetermined overhead rate, which would be the estimated fixed overhead divided by the estimated variable times the estimated direct labor hours. So our estimated total overhead is 720,000. Divide that by our estimated direct labor hours, which would give us $9 per direct labor hour. We would apply to this job the direct materials of 38,000, the direct labor of 21,000, and 280 labor hours times $9, our predetermined overhead rate, to have total manufacturing costs of 61,520. If you are so kind, can you put in there, how about yes or no? How many of you can just put in the chat box, did you get it right? Yes. Or did you get it wrong? Yes or no? And I'll see if I need to possibly do a couple more of these, okay? Because I really want you to understand what we're doing here. Yes, 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 yes. Oh, you guys are rocking it. Awesome, guys. Okay, it sounds like I don't need to go over this again. Great. Now, let's look at exercise 2.7. Again, I apologize. I shouldn't apologize. We do a lot of exercises in here because that's how you learn. You take the concepts and then you try to apply them. Han Company uses a job order costing system. Its plant-wide predetermined overhead rate uses direct labor hours as the allocation base. The company pays its direct laborers $15 per hour. And during the year, the company started and completed only jobs Alpha using 54,500 direct labor hours and job Omega. The job cost sheets for these two jobs are shown below. Our job is to calculate the plant-wide predetermined overhead rate. What are we going to do, guys, to determine the plant-wide predetermined overhead rate? If the company pays its direct laborers $15 per hour, and we've got the two jobs, can't we determine the actual, in this case, we can determine from this, we need the estimated, to determine our plant-wide predetermined overhead rate, we're going to need to figure out the estimated hours. Well, the way we can figure this, if we know the direct labor hours are $15 per hour, and we know job Omega has 345,000 of direct labor costs, we should be able to take that 345,000, divide it by $15 to figure out how many labor hours were involved with job Omega. We should then be able to take the manufacturing overhead shown on job Omega, divide that by the number of hours to be able to determine the predetermined overhead rate. Does that make sense? Let's see. If the direct labor hours, 345,000, we take that divided by the dollars per hour. We know on job Omega, they had direct labor hours of 23,000 hours. Now, the manufacturing overhead of 184,000, divide that by 23,000 direct hours, means we assigned a predetermined overhead rate of $8 per direct labor hour. Does that make sense how we got there, guys? How we backed in to get that information? Therefore, we were given the total job cost, weren't we? Then we know that the manufacturing overhead rate is of $8 per hour is going to be based on the number of direct labor hours. So we know the 54,000 direct labor hours actual at 15 bucks gives us our $817,500 in direct labor. If we take the 54,000 direct labor hours times our predetermined overhead rate, we can determine that the manufacturing overhead applied is 436,000. Therefore, we can plug in the direct material figure for the total cost on the job of $1,533,500 was given to us. Okay. Got it? Next, we are going to compute the total cost and the unit product cost of a job using multiple predetermined overhead rates. Let me stop a minute and let me look at this. I want to show you this slide.
A cost system with multiple predetermined overhead rates.
Hello, Nancy. I cannot hear the video.
Okay. I heard someone say y'all couldn't hear it, and I'm sorry. It's really light, and I don't know how to get that. That'll be my job for me this next week, is to figure out how to boost that sound. I wanted you to see an example of what we're getting ready to talk about right now. Dixon Company has two production departments, milling and assembly. The company uses a job order costing system and computes a predetermined overhead rate in each production department. So the predetermined overhead rate in the milling department is based on machine hours, but in the assembly department, it's going to be based on direct labor hours. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing cost to establish selling prices for all its jobs. At the beginning of the year, the company made the following estimates. So they estimated that machine hours for milling 60,000, they estimated the assembly machine hours of 3,000. But in milling, direct labor hours are 8,000, the assembly's 80,000. You see why it's important here for them to have different predetermined overhead rates in each department, because different things drive the milling versus the assembly. The total fixed estimated manufacturing overhead cost, $390 milling, assembly 500. Yet the variable manufacturing overhead per machine hour in milling is $2. The variable overhead manufacturing in the assembly for direct labor hours is $3.75. I just want to see what's being said here. Could you post a link to the video? Sarah, I've tried to post, I've tried to be able to figure out how I can share it. And I'm going to have to contact McGraw-Hill because it's not working as easy as I wanted to. And plus, I just want to make sure that I'm okay with copywriting. So guys, how do we calculate the predetermined overhead cost for each department? So during the current month, the company started and completed this job number 407. It wants to use predetermined departmental overhead costs and rate for the milling and assemblies department. So we know the milling department is $390,000 plus $2 per machine hour times 60,000 machine hours is 510,000. The assembly department's manufacturing overhead is the 500,000 plus the variable 375 times 80,000 labor hours to be 800,000. So we would determine the machine hour manufacturing overhead, which is this predetermined overhead rate, to be $8.50. And the assembly department would be the 800,000 divided by those estimated direct labor hours of 80,000 to be $10 per direct labor hour. Now that we know the predetermined overhead rate, we'll take that figure to figure out what will actually be applied to job 407. So if in the milling department we had 90 machine hours, at 90 machine hours times 850, the PO predetermined overhead rate is going to be 765. For the assembly department, direct labor hours is 20 times the direct predetermined overhead, $10. So the assembly would have 200. So the 765 and the 200 would be the manufacturing overhead that gets applied to this job. So if we take our direct materials for the job, we take our direct labor, and we take the manufacturing overhead that we now have applied, the total cost of job 407 is $2,485. Now, how are we going to determine the selling price? Well, it told us we're going to mark it up 75%. So if the total cost of the job is $2,485, and we're going to mark it up 75% of the cost, or $1,863.75, we know we'll sell this job for the sum of those two figures, the cost plus the markup, to show the selling price of $4,348.75. This departmental approach is going to result in a different selling price for job 407 than it would have been if we used a wide plant-wide overhead rate based on either direct labor hours or machine hours. So using a predetermined departmental overhead rate is probably going to be a much more accurate picture of costs, which ultimately enhances management and making decisions. Again, remember, one department, the driver is machine hours. One department, the driver is labor hours. Sometimes using multiple predetermined rates is the way to go, or usually I would say it is the way to go based on this unique situation. So guys, let's look at this exercise 215. Delft Company uses a job order costing system and has two manufacturing departments, molding and fabrication. The company provided the following estimates at the beginning of the year. So it tells us our estimates here. Let me just fix this slide. It's telling us that the Machine hours for molding is 20,000. Machine hours for fabrication is 30,000. For total hours, machine hours of 50,000. We've got our fixed manufacturing overhead, and then we've got our variable manufacturing overhead costs. During the year, the company had no beginning or ending inventories, and it started, completed, and sold only 2 jobs, job D70 and job C200. And the following slide will show what it gave us for these jobs. It told us the direct material costs for job D70, for molding 375, fab 325. Direct labor cost 200 for molding, 160 for fabrication. And then it told us the machine hours for molding 14,000 and the machine hours for fabrication 6,000 for a total machine hours of 20,000. Then job C200, it gives us all the same kinds of information. What we have to do is a bunch of stuff here, but this is what's going to be helpful. Assume Delph uses departmental predetermined overhead rates based on machine hours. The first thing we're going to do is compute the departmental predetermined overhead rates. That's our first step. Okay, so using the equation, the y equals a plus bx, the total machine predetermined overhead rate is going to be equal to the estimated fixed manufacturing plus the estimated variable manufacturing times the machine hours. So the total estimated manufacturing is going to be our 700,000 fixed plus our 60,000 variable manufacturing for a total of $760,000 estimated manufacturing. Since the estimated total machine hours is 20,000, that means our predetermined overhead rate is going to be $38 per machine hour in the molding department. Now, in the fabrication department, we're going to do the same thing. Take our total estimated fixed manufacturing, estimated variable manufacturing times our estimated machine hours to come up with a total of 240,000 divided by our estimated machine hours is going to give us $8 per machine hour in the fabrication department. Okay? $8 there. Now, the next thing that we're supposed to do is figure out the total manufacturing costs that are going to be assigned to each of these jobs. So if we've got in the molding department 14,000 actual machine hours at $38 for the predetermined rate, that's going to be 532,000 for job D70, 6,000 actual machine hours at the predetermined rate of 37 is 228. Then in fabrication, the predetermined overhead rate is $8. We're going to take 6,000 machine hours at $8 for 48,000 for job D70. And then for job C200, 24,000 actual machine hours times our overhead of 8 to give us the 192,000. So our total manufacturing cost for job D70 is going to be 1,640,000. For job C200, the total manufacturing cost is going to be 1,370,000. What are we going to bid? Well, we have to take those costs. We have to take our markup to come up with our bid price. Because the job doesn't have beginning or ending inventories, which we'll get to that down the road, it gets a little more confusing. We're basically going to take our manufacturing costs plus our markup to come up with the bid price. Okay, so our costs of $3,010,000 that were assigned, we will mark that up 150% to figure out what the bid price will be for the jobs. Let's see what this 2A is. Let me go back here, guys. 2A, compute the plant-wide predetermined overhead rate. Okay, assume Delph chooses to combine its departmental rates from requirement 1 into a plant-wide predetermined overhead rate based on machine hours. So what it wants us to do is compute now a plant-wide predetermined overhead rate. So in this case, we're going to take our million estimated total manufacturing, divide that by the estimated total machine hours of 50,000. And in this case, we're going to come up with $20 per machine hour. Remember on the other one, we had 2 separate categories per department. If we go this route, we're going to have $20 per machine hour. So as you see here, our total manufacturing cost here going this way for D70 is 1,460,000, where C200 is 1,550,000. And look what it was here, 1,640,000 and 1,370,000. You see, our bids are going to be so different based on that huge manufacturing overhead category. Again, what's the bid price? You can see it's for D70, 1,290,000. For C200, it's 2,325,000. The plant-wide and departmental approaches for applying the manufacturing overhead cost to products, identical cost and goods sold figures. But the 2 different approaches lead to significantly different bid prices. So the bid price for job D70 using the departmental approach is going to be 270,000 higher than if we use the plant-wide approach. Because the department they're really using more is going to be a lot more intensive, that work for this job. So in this case, you see, depending on how you approach the manufacturing overhead, it's going to really vary as to how your prices ultimately are going to be affected, which is why that departmental overhead rate is so important. Finishing up here, whether a job order costing system relies on plant-wide overhead or departmental does not usually have an important impact on the total accuracy of cost of goods sold as a whole, but it's going to have a huge impact on a job per job basis. Okay, So when a company creates overhead rates based on activities it performs, we call that applying an activity-based costing. This is a different approach to developing multiple predetermined overhead rates. This is used more accurately when you can measure the demands that jobs or products or customers or other cost objects make on those overhead resources. So the amount of overhead applied to all jobs during a period are going to differ from the actual amount of overhead costs incurred during the period. When a company applies less overhead to production than it really incurs, it's what we call we underapplied our overhead. It's kind of what I was showing you earlier on. Depending on what the actual costs are we over-applying or under-applying our overhead? When it applies more overhead to production than it actually incurs, then that results in what we call over-applied overhead. So the cost of goods sold reported on a company's income statement is going to then need to be adjusted to reflect any under-applied or over-applied overhead. If we need to adjust for under-applied overhead, it's going to ultimately give us a larger amount of cost of goods sold, which ultimately reduces our net income. But if we have over-applied overhead, that means our cost of goods sold is truly higher than it really should have been. Therefore, it decreases our cost of goods sold and ultimately will increase our net income. So all of the various job sheets that the company has working on jobs are part of the subsidiary ledger of the company. And all these sheets ultimately make up our set of financial records, which would be either our work in process or our finished goods that are showing up on the balance sheet. So ultimately, it will focus on going into cost of goods sold once the products have been sold, which affects our income statement. So what we're doing is we're seeing the big picture, the income statement, but we're really focusing on all the detail that makes up either the inventory listed on the balance sheets or the cost of goods sold that is affected in the income statement. So we're focusing on manufacturing in this segment of this course, but let's talk about a service company. Job order costing can be used in the service industry. It's different. Law firms, accounting firms, medical treatment can use a job order costing system, but it's handled a little differently. So guys, I have finished the review for this chapter. And unless there's any other questions, I am going to finish this recording so then we can look at some of the homework for this week. Any questions, guys?